All right, let's jump right in. We're going to tackle a really specific but super important piece of the accounting puzzle today. It's called International Accounting Standard 27, or IAS 27 for short, and it's all about something called separate financial statements.
So when you hear one company, two sets of books, I know what you're thinking. That sounds a bit shady, right? Like something's not quite right. But believe it or not, in the world of international accounting, it's totally legit. In fact, it's often required for legal reasons. And IAS 27, well, that's the rulebook that tells us exactly how to handle one of those sets of books.
So here's how we're going to break it all down. First, we'll get a handle on what these separate statements even are. Then, we'll get to the juicy part, the 3 big choices a company gets to make. We'll even take a quick trip back in time to see how this standard evolved, look at a real-world puzzle, and wrap it all up with what companies have to tell you.
Okay, first things first. What are we really talking about with these separate statements? I mean, if a big company already owns a bunch of smaller ones, why on earth would it need to create its own standalone financials?
Well, it really boils down to one simple difference. On one hand, you've got your consolidated statements. Think of these as the big picture. This is the family's total wealth, the parent company plus all its kids, the subsidiaries, all mashed together. But separate statements, that's totally different. It's like peeking into just the parent's personal bank account. It shows you exactly what the parent company thinks its own individual investments are worth, completely on their own.
And here's the official by-the-book definition. Now, the magic word here is elect. It means the company gets to choose how it accounts for its investments in these separate books. And IAS 27 is basically the menu it gets to choose from.
Which, of course, leads us right to the core of IAS 27. So, what's on this menu? What are the options a company has when it sits down to prepare these statements?
It's all right there in paragraph 10 of the standard. There are basically 3 paths you can take. First, you can carry the investment at cost, what you originally paid for it. Simple. Second, you can use the rules from IFRS 9, which usually means valuing it at its current market price, or fair value. And third, you can use the equity method. This one's a bit more dynamic. The value of your investment goes up and down with the subsidiary's profits and losses.
But, and this is a big but, there's a rule. You can't just pick and choose for each individual investment. No. You have to be consistent. So if you decide to use the cost method for your subsidiaries, then all your subsidiaries have to be measured at cost. It's all or nothing for each category.
So you might think this standard has always been this way, but that's not the case at all. It's actually got a pretty interesting backstory, an evolution that led it to where it is today.
Let's go back to 1989. The original IAS 27 was the one-stop shop for everything, consolidation and separate statements. But then in 2011, things got a big shakeup. A brand new standard, IFRS 10, came along and basically said, hey, I'll take care of all the consolidation stuff. A few years later in 2014, they officially added the equity method as an option, and bam, that gives us the standard we know today.
And that right there is the key takeaway from its whole history. When IFRS 10 showed up, it completely changed the game for IAS 27. It went from being the jack of all trades to a total specialist. Its only job now is to focus on the rules for a parent company's own books. That's it.
All right, so we've got the theory down, but what happens when the real world gets messy? Let's dive into a practical scenario that got so tricky, the official rulemakers had to step in and provide some clarity.
Okay, picture this. You buy a 20% slice of a company. You're just an investor. Then a year later, you buy another 40%. Now you're in charge. You have control. So if you've decided to use the at-cost method in your own books, what's the actual cost of that whole 60% stake? Is it just what you paid? It's not as simple as it sounds.
This is where it gets super interesting. There are 2 really logical ways to look at this. One approach is to say, okay, on the day I got control, what was my original 20% worth? Let's take that fair value and add what I just paid for the new 40%. That's one way. The other way is simpler. Just add up what I originally paid for the 20% and what I paid for the 40%. Both seem perfectly reasonable, don't they? So the big question is, what did the Official Interpretations Committee, IFRIC, have to say? They looked at it and their decision was, either one works. Yep, they said both approaches are acceptable. And this is such a great reminder that accounting isn't always a simple black and white answer. The key is picking a reasonable method and sticking with it. Now, all this flexibility is great for companies, but with great power comes great responsibility, right? In this case, that responsibility is transparency. So for our last section, let's talk about what a company absolutely has to disclose in its financial statements. Paragraph 17 lays it all out. A company can't just drop these statements on you without any context. They have to come right out and say, hey, just so you know, these are separate financial statements. They need to give you a list of their major investments, subsidiaries, joint ventures, and all that. And crucially, they have to tell you which of those three methods, cost, IFRS 9, or equity, they chose. It's all about making sure you, the reader, can understand the story behind the numbers.
And that really brings us full circle. IAS 27 is all about giving companies choices. As long as they stay consistent, they get to pick whether to report their investments at cost, at fair value, or using the equity method. But what we've just seen is that even a word as simple as cost isn't always so simple. It can mean different things depending on the situation. Which leaves us with a really important question, one that's at the very heart of financial analysis. The next time you see a number on a balance sheet, will you stop and ask yourself, what's the real story behind it?